Jay, everyone expects that the Fed will cut at least 25 basis points when they issue the statement later this week. But I'm curious, do you think it's one and done? Because you have raised your end of year target for the S&P 500. Help us understand what's going on.
Thanks, Adam. It's great to be on. Well, it's an interesting time on the Fed because you've got, or you're going to have, three new Republican members. And then I'm talking about the core Federal Reserve Board, not the whole FOMC. And then four Biden administration, and I'm including Powell because he was renominated. And the Biden appointees are Keynesians. They're more focused on the labor market. And that's important because the labor market is weakening. So we think, notwithstanding, they're also nervous about tariffs and expectations theory of inflation. So I think there'll be common ground and we'll get at least two cuts, probably a little bit of a hawkish cut on Wednesday. So in other words, Powell will say, oh, we're data dependent and we'll see about the next cut. But I think we'll get at least two. And then going into next year, you're going to get a new chair. So what's really important is the terminal rate, which right now is hovering around 3, because that very few people appreciate that. The terminal Fed funds rate determines the 10-year. 10-year is right around 4. And I would argue that there should only be one financial condition you look at, not conditions. So in other words, focus on the 10-year and then the impact on mortgages. Mortgage rates came down already, so that's bullish. So even if the Fed's a little bit slower than we would hope, as long as the 10-year and expectations of longer-term cuts stay intact, then the economy should grow next year around 3%.
Okay, so I want to break this down, and I'm repeating what I heard you say to make sure that not only I, but that we understand it. The Fed cuts, 25 basis points, maybe 2 or 3 times by the end of the year. That's the first key point, correct?
Right.
That brings down the overnight rate, obviously, but it brings down the terminal rate. But then the impact is it would bring down the yield on the 10-year. Is that what you're telling us?
Absolutely. And that's a little bit controversial, but correct. What happened a year ago is everybody said, well, the Fed cut rates, but the 10-year went up. With the notion being like, oh, it's terrible for long-term inflation. But what really happened is the Fed cut and then put out a bunch of hawkish commentary about cutting in the future, and the terminal rate rose. So, and then also people say, oh, it's because of the budget deficit or the OBBA or a lot of other factors. But really, statistically, it's 70% driven. It's really kind of 95% driven if you look at it by the Fed funds rate and the terminal Fed funds rate. So I'd keep my eyes on that. Right now, it's stabilized at 3. I think even if there's a hawkish pause, it'll stay right around 3. 10-year should be pretty range bound. And that's just a great situation for stocks and for bonds, for that matter, higher risk bonds, and for the stock market.
I just want to make sure, because I'm not a Fed expert, terminal rate is the top. It's the peak rate that the Fed expects. Is it not regarding its? Or
it could be either. When you're raising it, it could be the highest, but when you're cutting, it's the as low as it's going to go. And by the way, we shouldn't go below 3 because then the Fed would have to increase the money supply dramatically to do that. Like the president has argued for going to 1. We would have almost certainly double-digit inflation if we had Fed funds at 1.
So the goal is to get us closer to 3, the terminal.
Correct. And then what happens too, nobody really appreciates this. Then you get a gradually increasing money supply. And it's roughly at the same rate as nominal GDP. And if you're a monetarist, which I am, and you should be, then inflation will be relatively stable. It's not perfect. When oil prices are skyrocketing, that doesn't work, but otherwise it pretty much works.
Again, as a novice when it comes to the Fed, even though I covered them for many years, if they cut rates, why is that going to help the labor market? I understand what it does with inflation, and I'm actually wondering why we wouldn't see an inflationary spike if they cut rates. But first, why will it help the labor market?
Well, so the Fed, to lower the Fed funds rate, they have to inject more liquidity in the banking system. That then flows, and and affects the bond market, long-term bond market. Then mortgage rates come down. So they've already come down 70 basis points. That's kind of my point. Like there's already been an easing as long as they're not super hawkish. And then it's really the key driver, one of the key drivers of employment is old economy investment, which is construction and housing. And by the way, nobody ever talks about this. We have data on our website you can go look up. But those two sectors are in recessions. In other words, negative year-over-year growth. And I would always watch investment to predict GDP, not consumption. Consumers consume sort of like woodchucks chuck wood. Like they usually don't just stop consuming unless they're laid off or some heinous event occurs. So it's watch investment. Housing's very weak, but should recover with this more dovish Fed.
And that puts people back to work, as well as the ability of a small business to borrow money that right now they might not be able to get.
Absolutely. Well, the thing about housing is it's not just like building houses, although that's important. But think about what goes into a house: appliances, carpet, painting, moving. So the process of creating new homes and stimulating new sales and people moving is a huge driver of economic activity and employment, because those are all labor. There's no AI that builds houses or installs carpet. So big driver of employment.
Perfect real world examples. Just recently, Sherwin-Williams, I used to live in Cleveland. It's headquartered there. They just announced, because of a bad economy for them, people aren't buying paint to fix up their homes. They're not selling. And therefore, they suspended their 401k match.
Absolutely. Well, it's a key driver. It's an unusual situation where we have this huge tech boom that has some real economy impacts, which it never did before. So because you never had that computing requirement when during the internet boom, you just had computers and software. But now you have all that infrastructure, which includes electricity. So it's actually stabilizing the economy. So two sectors are in recession, but two are very strong. So you haven't seen a recession. It's very unusual during a Fed tightening cycle to not have recession, but we do have weakening. So it's good the Fed has finally figured out they need to cut. I mean, they're fatally flawed, but they have finally figured that out.
Long time ago, you and I talked about some of the flaws with the Fed when there was this potential for President Trump to make a move to try and fire Jay Powell. I am curious. I want to jump to your call on the S&P 500. Are you expecting then this cut and the next cuts that will be coming to propel us into a much stronger 2026? I mean, we have record close just this week on the S&P 500 and the NASDAQ.
Absolutely. So it's important always to focus on the data and not the opinions. Or, by the way, who's giving the opinions? I've been challenged on air, with somebody who's worth 50 billion and their opinion. It's like, well, I don't care about the opinions. What are the facts? So here are the facts. So we had out a 6,600 target. That's 22 times next year's earnings, right? A year-end target, you always look at 26. We think because of the AI boom and the fact that we're likely with these lower rates to have 3% economic growth, so the housing market will recover, all that paint will get used and carpet. And then you'll have better also construction, not just housing, but commercial construction. So with that, you should get normal growth, which is around 3%. That's a tailwind to earnings. AI is a tailwind. So we think we'll hit that 305 is what we're assuming for S&P earnings. 23 times, that gets you to 7,000. And then we also initiated a year-end 26 target, which is 7,700. That's pretty much the earnings growth projected. And we think we can hold that 23 multiple. It also does matter to have lower rates because rates and S&P multiples are inversely related. So it's important to have fairly low rates if you're going to have elevated multiples on the S&P. 23 is historically high.
I don't know if this would be in your expertise, but help me understand if you can. I would have thought gold would start to come down, and yet I keep seeing gold hit new highs. What's driving that? Is it fear over tariffs, or is it those of us who really don't understand the metrics and the data that drive different asset classes?
Well, it's a great question, because normally what would drive gold would be a weak dollar and lower rates. So now we do have lower rates. We peaked at 480. We're roughly at 4 now. So that's a tailwind. The dollar also came off. So those are two positives for gold. But there does seem to be a third dynamic, which is heavy demand from overseas, particularly Asia and central banks in Asia. So for whatever reason, they're adding gold reserves to their monetary reserves. So that's been kind of like the third tailwind. It's turned it almost gold into almost like a meme stock where it just goes up every day.
If you were going to do my job and help me, because I love people to do my job, what's the headline? What would you write as the headline for this discussion?
I'd say the headline is that we're in a period like the late 1990s, which was, if you recall, fortunately, some of us recall quite well, that you had the Fed jacking up the money supply because they were worried about Y2K. And you had the internet boom. So you had monetary policy and a big development on tech. And that was a great time to make money. I was an investment banker. It was great for investment bankers, great for investors. So I think we're headed into effectively kind of boom time because of those two dynamics.
I would just say I am old enough to remember that, but I also remember what happened when that bubble popped.
Yes, I would just only point out that bubbles actually are an efficient element of the U.S. capital market because all that capital flowing in, chasing the bubbles, creates the next winners and for the next technology wave. So that's why we have the Mag 8 and everybody else has zero. So there was a bunch of money wasted during the internet boom in the late 90s and early 2000 for 1 year. But then we created these multi-trillion-dollar companies. So it is at some point the music will stop and you have to find a chair, but just keep in the back of your mind, it's actually good for the world. We get faster technology, great companies, and a bunch of failures as well.